Welcome to Money Flow IQs, where smart money meets smart learning. Our channel is dedicated to empowering you with essential financial literacy and effective investment strategies. Join us to navigate the complexities of finance and build a secure future. Subscribe for insightful content.
Today, we're jumping into a really interesting day trading strategy called the box theory. And it's all built on one simple idea, which, kind of goes against the grain in the super complex world of finance. When it comes to trading, simple is almost always better. And this one phrase from the guy who came up with it really captures the entire philosophy. The whole point is that the less complicated your strategy is, the faster and more confidently you can actually act on it. I mean, that makes a ton of sense, right? The more things you're trying to watch, all these different indicators, a million rules, just noise, the easier it is to get stuck in analysis paralysis. And that hesitation, that can literally be the difference between making money and losing it. So what's the fix? Well, it's a super visual framework called the box theory. And it all starts by drawing one single, simple shape right on your chart. Okay, so making this main box is about as easy as it gets. Seriously. You just look at the last trading day, find the absolute highest price a hit, find the absolute lowest price a hit, and you just draw a box connecting them. That's it. That's your entire playing field for the day. But here's the cool part. This box isn't just some random rectangle. It's basically a map of the market psychology from the day before. The top of that box, that's your resistance zone. It's where all the sellers showed up and said, nope, price isn't going any higher. And the bottom, that's your support, where all the buyers stepped in and said, this is a bargain, we're buying here. So you've got your box drawn, now what? Well, the strategy has 3 core rules for you to follow, especially right when the market opens. Think of these as the absolute rules of the game. These rules are all about keeping you trading at the edges, because that's where the best opportunities are. The thinking is simple. The sellers who showed up at the top of the box yesterday are probably going to show up there again. Same for the buyers at the bottom. And the middle? That's just a messy free-for-all. It's pure noise, and you want to stay out of it. And the creator has a great way of putting it to really hammer home that third rule. Don't dawdle in the middle. The idea is that your chances of being right are just way worse in there, far away from where the real battles between buyers and sellers were fought yesterday. Okay, theory is great, but let's see how this actually works in a real trade. The source gives us a perfect case study using the stock Palantir, which trades under the ticker PLTR. So here's the setup. Palantir starts its trading day with the price opening right down near the bottom of that box we drew. What does that mean? It's landing smack dab in what the theory calls the zone of dominant buyers. So let's think about this. Based on the rules we just went over, what's the move here? The price is right there at that support level, deep in buyer territory. If you absolutely had to make a move, what would it be? Yep. According to the box theory, the only move to make here is to buy. You're essentially betting that the same big group of buyers who thought this price was a good deal yesterday are going to think it's a good deal again today. The source even gives us the specific entry price, $85.41. But what's really important is that the trade wasn't just taken because the price touched the line. No, it was triggered after a specific visual cue. A bullish candle pattern popped up. That's the confirmation, the little signal that says, hey, buyers are actually stepping in right now, proving the theory right in that moment. And what was the result? Well, would you look at that? The stock did exactly what the theory said it would. It bounced hard off the bottom of that box and started a really strong climb back up toward the top, right toward the seller zone. But hey, what happens after that first big morning move? The market keeps going all day, right? Well, this is where the strategy adapts. You start creating new, smaller boxes as the day goes on. So, as the trading day unfolds, new little peaks and valleys get created. You can just draw new, smaller boxes around these fresh ranges. And guess what? The same exact rules apply. You're looking to buy at the bottom of that new little box and sell at the top of it. Now, this brings us to a really important idea, what a true breakout is. According to this theory, a breakout isn't just a big, fast move. A true breakout only happens when the price closes completely outside of one of your boxes, either above the top or below the bottom. That's the signal that the old rules don't apply anymore and a much bigger move could be starting. All right, let's wrap this up and just quickly recap the absolute core principles of the box theory. So it really just boils down to these 5 things. First, remember that stupid simple mindset wins. Second, define your field of play. Box in yesterday's high and low. Third, the game plan. Buy low, sell high. Fourth, and this is huge, stay out of that messy middle. And last, trust your levels. Believe in your box until the price proves it wrong with a true breakout. And that really leaves us with a final question to chew on. In this world of high-frequency trading, complex algorithms, and a million different indicators, the box theory asks something different. It makes you wonder, maybe, just maybe, by ignoring all that noise and focusing on one dead simple visual, a trader can find a much clearer, more powerful edge.